All right, let's talk about something that's, one of the most seductive and dangerous corners of the stock market. Penny stocks. We're talking about these tiny companies that promise absolutely massive returns. But the real question is, how much of that is just a dream and how much is reality? Well, we're going to dig in and find out.
I mean, this is really the big question, isn't it? The dream of snagging that one hidden gem, a stock that's just a few rupees today but could just explode in value tomorrow. It's such a powerful idea, but is it actually realistic? That's what we're going to try and unpack here. Okay, so you've probably heard this term multi-bagger thrown around a lot when people talk about penny stocks. It's actually a pretty simple idea. It just means a stock that multiplies your investment. So if your stock doubles, congrats, you've got a two-bagger. If it goes up 500%, that's a five-bagger. And of course, the holy grail is finding that 10-bagger or even a 100-bagger. That's the dream.
And that right there is the dream. It's this powerful, compelling story that really drives the whole penny stock craze. This idea that you can be the one to find the next big winner that nobody else sees coming. And this quote, wow, it just nails the appeal, doesn't it? It's not just about getting wealthy, it's about getting wealthy fast. It's this fantasy that you can skip all those years of slow, patient investing and just hit a home run with one single brilliant pick. It's so tempting, but you know there's always a catch, right? Because for every one of those amazing success stories you hear about, believe me, there are a ton of others that just crash and burn. So let's get real for a second. It's time to pull back the curtain and look at the very real dangers that are hiding in this space. So there are basically four huge red flags you've got to watch out for. First, low liquidity. In simple terms, that means it can be a nightmare to sell your shares when you want to. You might get stuck. Second, there's often very limited data. You're flying blind. Then you've got insane volatility. I mean, the smallest piece of news can send the price soaring or plummeting. And the biggest risk of all, the company could just go belly up, and poof, your investment is gone. Worthless. And this chart really puts it into perspective. Look at the difference here. Investing in penny stocks is absolutely nothing like buying a solid, stable, blue-chip company. It's a completely different universe. Everything, the volatility, the data, the risk, it's all turned upside down. You can't use the same playbook. It's a whole new game. Okay, so with all these massive risks, you have to be wondering, how does anyone actually try to find a winner in this mess? Well, it's not about just throwing a dart at a board. There's a method to the madness, a way to try and sift through all that noise. The number one tool in the toolbox for this kind of hunt is something called a stock screener. Honestly, just think of it like a super-powered search engine, but for stocks. You can plug in all sorts of filters, like show me companies with a price under 50, a market cap over 100, and a solid financial health score. It lets you take this ocean of thousands of companies and shrink it down to a manageable pond. It's all about finding that needle in the haystack. But look, a screener just gives you a list. It doesn't give you answers. That's where the real work, the homework, kicks in. You gotta roll up your sleeves and dig deep. Is this company actually making money? Does it have a mountain of debt? Who's in charge here? Do they have some kind of special sauce, a competitive moat that protects them? Answering these questions is what separates real investing from just gambling. Okay, that's enough theory. Let's get our hands dirty and do a real-world reality check. We're going to look at a company that pops up on these lists all the time, UCO Bank. Let's crack open its latest performance report and see what the numbers actually say. First up, net profit. It's almost 620 crore rupees. So hey, the bank is making money, which is a good start. But, and this is a big but, the year-over-year growth is just under 3%. I mean, that's fine, it's steady, but it's not exactly the kind of explosive growth you'd expect from a multi-bagger in the making. Okay, now this next number is super important. We're looking at non-performing assets, or NPAs. All that means is bad loans, money the bank lent out that isn't getting paid back. So you want this number to be as low as possible. And check this out. UCO Bank has really improved here. They've dropped their NPA ratio from over 3% down to about 2.5%. That's a huge plus. It tells you they're cleaning up their books and managing risk better. All right, next, let's look at return on equity, or ROE. The easiest way to think about this is like the bank's report card. It shows how good they are at turning shareholder money into actual profits. Their score is almost 8%. Now, that's not bad. It's a passing grade for sure, but it's definitely not an A+. Compared to the industry leaders, it's just, okay, solid but not spectacular. And this is where we get the real context by putting it side by side with its competition.
When you look at UCO compared to its peers, you can see it's kind of stuck right in the middle of the pack. It's not as profitable as, say, Bank of Maharashtra, but its books are cleaner than Bank of India in some ways. It's not a standout winner, and it's not a total loser. And honestly, that's what you find most of the time when you actually do the digging. So what's the final verdict on UCO Bank? Well, there's no easy answer. It's a mixed bag. On the plus side, they're cleaning up their loans and they have a solid capital position. But on the minus side, their profits are just so-so, and the big institutional investors, they're not really biting. This is it. This is the messy, complicated truth you uncover when you trade the hype for some actual homework.
So we've gone on quite a journey, haven't we? From this exciting, high-flying dream of instant riches all the way down to the nitty-gritty of a bank's balance sheet. So what's the big lesson here? What should you actually take away from all this? Well, it really comes down to this journey, right? It's fine to start with that dream of finding a big winner, but then you have to get serious. You have to understand the risks. You use the tools like screeners to get some ideas, but then you have to face the music and analyze the messy reality of the actual company. At the end of the day, the goal is to shift your mindset from hope and hype to solid, evidence-based homework.
And this quote about UCO Bank just sums it all up perfectly. Yeah, there's a good story here. A turnaround is definitely happening. But it's not a rocket ship to the moon. The pace is slowing down, and the future is anything but guaranteed. It's a complicated picture, and understanding that is probably the most important lesson of all. So, I want to leave you with one final thought. The next time you see that headline, you know the one, screaming about the next 10x penny stock, you'll have a choice to make. You've seen the hype, you've seen what the homework looks like, now you know there are two sides to the story. So the question is, how are you going to read that next headline?